Was an important corporate that ushered in the earnings season with much fanfare and a decent set of numbers. Let's get back to the markets. At this point in time, it's still a little under the weather. 0.25% off the Sensex and the Nifty, so that 8450 is a formidable wall of resistance. And the Bank Nifty is not absolutely the one that's taking the market down. It's actually performing with the market. That one is also down just about 0.2. Mid-caps are just about holding up, and the advance declines are still a shade in favor of the advances. But clearly, the markets are stalling at these levels, finding it difficult to move ahead. Let's ask our market master where things are headed from here on. Pramod Gubbi, the Director, Institutional Sales at Ambit Capital, joins us. Good morning, Pramod. Good to have you with us. Do you think valuation concerns are legitimate at this level? Crossing the 8450 mark or 8,500 is legitimately difficult because valuations don't support?
Yeah, I would think so. I think valuations need to be seen in light with what potential earnings growth are you looking at, both in the near term as well as in the medium term. I think the longer term story is still intact, so to that extent the multiples may not change. The bigger concern will be what will drive earnings growth in the next year or so. To that extent, pretty much every evidence that we see on the ground doesn't suggest any sort of change in the trend that we've seen in the past few earnings seasons. So this earnings season shouldn't be any different from that. There doesn't seem to be any indication that it will change in the next 2 quarters either. So I think more than valuations, people are more than happy to give the valuations that Indian structural story demands, particularly given that there isn't much going on elsewhere in the world. But the real concern is, where is the recovery that we've all been waiting for?
Pramod, hi, good morning. That is actually the concern that most brokerages, most experts have. In your interaction with foreign investors, are you noticing that the enthusiasm towards India has diminished a bit, and are FIIs trimming their positions on India?
Not really. I think if at all there's been a change in that trend. We did see some sort of reversal, some sort of reduction in the huge overweights that FIIs have on India in their portfolios sometime in April, May, I think when China was rallying. But in the past few weeks after the Chinese correction, I think we have indeed seen some sort of reversal back into India. So I don't think that is a concern just yet. But if things prevail with a lack of an earnings recovery for much long, maybe there'll be further reduction in the overweight. But we're not there yet.
How negative is the inflation number that came in yesterday? Will that deter you from buying the Nifty or buying some stocks?
Not really. I mean, it's one of many factors, of course. But clearly what that suggests is hopes of a rate cut further in this calendar year are further diminished. So to that extent, any respite on rate sensitives in terms of lower interest rates are that much lesser. But like I said, it's clearly one of many other factors. There are fundamental demand and supply factors which are holding back economic growth, and that's more fundamental than at the margin interest rates itself.
Okay. You did mention that FIIs in the past few weeks have been increasing their allocation towards India. So what are the pockets or the sectors that you're seeing more flows into now? I
think it is still largely defensive, in the sense defensive both in terms of sectors as well as quality. We have seen people adding to the favorite sectors like private sector banks, some element of money into some high quality cyclicals. Pharma continues to attract attention, but yeah, so more than the sectors, I think people are sticking to quality. The best performing stocks fundamentally, which have given strong earnings growth over many years, those continue to attract much of the investments.
When do you see the earnings cycle turning, Pramod?
Yeah, it's a tough one, really. I mean, from what we see, I think there's a lot of headwinds going forward. There are a number of elements which are playing against any sort of potential earnings recovery. One is the subsidy change, which we've talked about, which has clearly hurt consumption in many sectors, particularly rural consumption. The second is a broad-based pullback in real estate. I think this is across the country, both in terms of transactions and prices. That's having its own trickle-down effect on consumption of building materials, labor. There is clearly significant excess labor because of the cool-off in construction activity. That's also further adding to the rural wage inflation coming off quite sharply. And that in turn affects consumption again. So every aspect of the economy is seeing some sort of a headwind. Even the government capex that we had been waiting for the government to lead the recovery in investment demand hasn't been particularly great. I think there was a pickup in April, but May has been relatively weak again. So it is not out of the ordinary. And in any case, it isn't large enough to justify a broad-based economic recovery. So that remains elusive. That has to trickle down into corporate profitability at some stage, and that is what will drive earnings growth. So to that extent, the visibility is very poor. I think at least for the next 2 quarters, we're not going to see any recovery, perhaps even longer than that.
Okay. Well, actually, this ruling about the fall in subsidies of the NREGAs and the food subsidies, you know, all through the UPA regime, and even very recently we had a rural market expert telling us that 1 rupee in infrastructure brings 5 times multiplier output to rural India than 1 rupee of subsidy. Shouldn't that argument kick in at some point?
Correct, but the question is, where is the spend on infrastructure?
Right.
We haven't seen that either.
Okay. Pramod, you know, because of the issues that we're seeing in China with respect to slowdown in growth, etc., there are companies in our own markets that are getting impacted. Top of mind is Tata Motors, which has got severely derated. How do you deal with some of these stories where the managements are good, the long-term story is intact, but the near-term problems persist?
I mean, China, to some extent, remains an enigma. It's not like demand is collapsing there. It is still growing at a healthy pace. But I think in Tata Motors' case, it's more company-specific than a broad-based slowdown. Remember, Tata Motors is still fairly small in terms of market share in China. It's not a story of market growth. It's more of market share gains. There have been changes in its portfolio mix. There has been a shift of production from UK-based production to local production, which is affecting its ramp-up and volumes. So I would agree with you. You know, good management, solid brand distribution, worth waiting for the long-term pickup. Sooner or later, volume should come back, and the stock is at attractive valuations.
How are your clients approaching the Indian IT space? Are they seeing Indian companies as making that evolution towards digital opportunities and big data opportunities well? Is there a big amount of money being given to IT, or is money being withdrawn there?
I think there's still a big question mark on whether the Indian IT companies will successfully evolve and compete with the large guys globally in this new digitized world. You can see pockets of investments bearing fruit with some specific companies. We see some specific companies actually managing this transition much better than others. To that extent, I think investors will be better off by working bottom-up, identifying those very companies which will make this transition much smoother than a broad-based recovery. There will definitely be some of those companies who won't make the cut. So unlike in the past 10 years when most of the top Indian IT companies did well, grew well with the market, I think here there will be scope for stock picking.
Okay. Another pocket that has seen, that has caught the fancy of investors once again is the smaller private sector banks after IndusInd's good numbers, the likes of DCB, Federal Bank, South Indian Bank, etc. From that lot, is there anything that you like?
I would rather not comment on any specific bank here, but I think there are a couple of them, particularly regional banks, which have demonstrated, you know, long-term growth and strong capital efficiencies. Those continue to remain the better performing ones. Some of the names that we have liked in the past have been City Union Bank and DCB Bank. Yeah, I think that's pretty much what I'd like to comment on this sector.
I mean, what kind of levels do you think will be attractive? You don't buy at 8,500, you buy at 8,000. Would that be a fair way of describing your position?
I think the better way to look at it is fundamentally we look at the market's earnings growth. Like I said, I don't think the structural story has been broken to that extent. We won't want to play around with multiples. It's just keeping the multiples intact. The way we see it, the market seems to be still expecting around 14-15% earnings growth for this year. This is FY16. We find it tough to see that going anywhere beyond 8-9%. To that extent, I think there is still a scope for a 7% reduction in the market's expectation of earnings growth, and that's the sort of downside we would look at the market.
Okay, that's neatly arithmetically put. Pramod Gubbi, pleasure speaking with you. Thank you very much for joining us today. Okay, so that's the word coming from an expert that probably a tad expensive the market's on.